Welcome to The Explainer. Today we're going to tackle a concept that, let's be honest, can feel a little like financial wizardry. It's a way to profit from pessimism. We are talking about short selling.
So let's just jump right in with the big question, the one that kind of flips investing on its head. I mean, we're all taught buy low, sell high. But what if you could sell high first and then buy low later? How on earth is that even possible?
Well, the answer is a strategy called short selling. And really, at its core, it's all about selling something you don't even own yet. You borrow it, you sell it, and then you really hope you can buy it back cheaper to return it, and you get to pocket the difference. Okay, so this means we have to completely reframe how we think. Instead of searching for a company you believe is going to succeed, you're actually looking for one you think is overvalued, one that's headed for a fall. Now, some people see this as a really vital part of the market. It's a way for investors to expose hype and pull prices back down to reality. You are quite literally betting against a stock. To really get this, let's forget about stocks for just a minute. Imagine there's this super hyped up comic book. You borrow it from a friend and you turn around and sell it immediately to a collector for 50 bucks. A month goes by, the hype is gone, and you find that exact same comic in a bargain bin for 20 bucks. You buy it, give it back to your friend, and hey, you've just made $30. That right there, that's a short sale in a nutshell.
Okay, so let's swap out that comic book and get back to the real world of stocks. We're going to use a totally fictional company, let's call it Gizmo Corp, to walk through exactly how this works on the stock market. So let's set the stage. Right now, one share of Gizmo Corp is going to cost you $100. You've done your homework, you've read the reports, and you are convinced that price is way too high and it's about to drop. So you decide to make a move. The whole thing, really, it just boils down to these four basic steps. You borrow the shares, you sell them on the market, you wait for the price to drop, and then you buy them back. Let's see how this plays out with our friend Gizmo Corp. Okay, so you call up your broker and boom, you do steps 1 and 2. You borrow one share of Gizmo Corp and you immediately sell that borrowed share on the open market for its current price, $100.
This is a really crucial point. Think about where you are right now. You've got $100 in cash sitting in your account from that sale. Great. But, and this is a big but, you also have a debt. It's not a money debt, it's a share debt. You owe your broker one share of Gizmo Corp. And now, you wait. It's the waiting game. And in our perfect little scenario here, your bet pays off. Maybe some bad news hits the company, or maybe investors just realized it was overpriced and the stock price plummets from $100 all the way down to $70. That drop is your signal. It's time for the final step. You jump back into the market and you buy one share at that new, much lower price of $70. Then you take that share and you give it back to your broker. This final act of buying back the share, that's what's known as covering your short. So let's do the math here. You sold for $100, you bought back for $70. That $30 difference, that's your gross profit on the trade before any fees you paid to borrow the stock. You did it. You successfully made money on a stock that was going down. It all sounds pretty easy when your bet pays off, right? But what happens if you're wrong? What if instead of falling, the price of Gizmo Corp starts to go up and up and up? This, my friends, is where short selling gets incredibly dangerous. There's this classic quote that just nails the danger here. You might be totally right, fundamentally, that a stock is overvalued. But a surprise bit of good news, a wave of social media hype, or just the market being totally irrational can send that price soaring against you. All right, let's rewind and go back to our Gizmo Corp example. You shorted it at $100, but now Gizmo Corp announces some revolutionary new product and the stock shoots up to $150. Well, guess what? You still have to return that share to your broker. So to cover your short now, you've got to go out and buy it for $150. That means you just locked in a $50 loss. And this right here, this shows you the huge difference in risk. If you buy a stock for $100, what's the worst that can happen? Well, it can go to zero and you lose your $100. Your loss is capped. But when you short a stock, there is theoretically no ceiling on how high its price can go. 200, 500, 1,000, your potential for loss is, well, unlimited. So with all these massive risks, if you're ever thinking about this kind of strategy, there are some absolutely critical things you need to consider first. This is definitely not for the faint of heart, and it's not for the unprepared. So here's a quick checklist. You absolutely need to know the costs and fees for borrowing the stock. You need to have a rock-solid reason for why you think the price will drop, not just a gut feeling. You have to be aware of something called a short squeeze, which is where a rising price forces all the short sellers to buy back in a panic, which just pushes the price even higher. And most important, you have to have a plan to get out and cut your losses. And never, ever forget that potential for unlimited risk.
All right, let's bring it all home. What are the key things you need to walk away with from all this? Okay, so 3 big takeaways. Number 1, short selling is a strategy to make money when a stock's price goes down. Number 2, the process itself is simple. Borrow, sell, buy back, return. And number 3, the most important one to remember. While your potential profit is capped, your potential loss is in theory unlimited. So now you know the how. You know the mechanics of betting against a stock. But that really leaves us with a much bigger, much more interesting question, doesn't it? What actually makes a company's value fall? What are those real-world events that send a stock price tumbling? But that, well, that's a story for another explainer. Thanks for joining us.